VectorVest International. Hard to believe it's August already, Saturday, August 5th, and it's great to have so many of you with us. Really appreciate you giving us your time on a Saturday. We value that so much, and we've got a terrific lineup of speakers for you. It's going to be a very entertaining and informative presentation for you. For those of you who don't know me, my name is Stan Heller. I'm VectorVest consultant for VectorVest Canada, and I'm broadcasting from Lethbridge, Alberta, where we have just a terrific summer day again in southern Alberta. So it's great to have you, and yeah, I see a lot of tributes coming in for our good friend, Dr. David Paul, and thank you for that so much. Tremendous loss to the VectorVest family. We appreciate your kind words. But listen, we've got an excellent presentation for you today, and I think we're all set to get started. It looks like maybe people could let me know if they can hear me okay. Yep, I do see. Thank you, Tom and others. It's great to have you with us. And I'm going to go through and the agenda in a minute, but just make sure your computer speakers are turned on and the audio portions are loud and clear for you. The recording, of course, will be archived on VectorVest YouTube channel. And so the recording is available almost immediately after the webinar. So that's a really nice feature. Joan, so good to see you, and thank you so much for tuning in and your kind words. Thank you, Marty, and everyone. We appreciate it. Our quick risk disclaimer. There is risk in investing, and everything you see in here today is provided for educational purposes only, should never be considered as investment advice, and the information is designed to empower you to make your own investment decisions, and these decisions are yours and yours alone to make. Audrey, good to see you. So many VectorVest friends joining us today, and we really appreciate it. So thank you for that. The purpose of our meetings, of course, is to provide the opportunity for VectorVest subscribers, all of you from around the world, to interact and exchange ideas and to advance everyone's knowledge of the VectorVest system. You're going to learn a lot about that today from our presenters, and of course, the current market conditions. And finally, to share the best ideas and strategies for making money, and most importantly, I think, protecting your wealth. Very, very important. So here's our agenda. We have our urgent market review and trade ideas with the color guard reports, and that's going to be presented by Rick Franklin, VectorVest Canada, and Glenn Tompkins, a senior instructor. All of you are familiar with Glenn's YouTube presentations and Jockey Club and everything else, and he does such an amazing job, and we're just thrilled that he's with us today. And then very excited to announce our keynote presentation all about ETFs. This is going to be presented by Les Masonson. Les is not only a VectorVest subscriber, but he's an author and a contributor to Stocks and Commodities magazine, very, very well read, and we're just thrilled that he's here to talk about ETFs. And just before I introduce our friend Rick Franklin, just know the replay will be available on YouTube again. Some of you have just come into the room, and will be available on YouTube immediately after the webinar, same location. And then the slides will be sent out by VectorVest, typically by Monday afternoon. You will have an email that recaps the proceedings today and gives you the slides for your saving to your computer. So with all of that, now I'm truly delighted to introduce our newest VectorVest Canada consultant, Mr. Rick Franklin. Rick is not only a well-informed and passionate trading coach, but he also has an outstanding track record of investing in both the Canadian and US markets. And Rick merges his experience as a senior engineer with the Department of National Defense in Ottawa, here in Canada, with an extensive understanding of the Canadian and US stock markets and VectorVest's innovative market and stock analysis. And Rick has already demonstrated his skills and enthusiasm for teaching all this as host of our Tuesday weekly market update. And now we're thrilled to announce Rick as host of the International Online Forums. So with that, please welcome me and or join me in welcoming Rick Franklin. And Rick, I'm going to turn it over to you.
Thank you very much, Stan. Thank you so much for that introduction. And yeah, I'd just like to take this moment to say how privileged and honored I am to have been chosen to represent VectorVest in this role, and very thankful to all of the folks that have been helping me out so far in progressing, learning, and trying to perfect this role, including VectorVest is a family. So including all of the subscribers who already have been tuning into the weekly market update. Thank you very much for all the welcomes I'm seeing now, and also the patience as I work to try to get up to speed and perfect the delivery and the education experience to everybody. So with all of that said, let's get into some slides and let's look at some color guards and market timing graphs from around the VectorVest world. All right, so we've got slides up here. The first thing we're going to take a look at is Canadian and US color guards here. I won't do the color guard review on these slides. We'll be doing that with the program itself. But just to say, you can see over on the right, we've got a recap that we've done there. You can see that across the VectorVest world, we haven't done too bad of late. In the month of July, if we go down the list, you can see in Canada, we were up 2.36%. The US was up 3.74%. Australia, 2.41%. The EU, an even 2%. And the UK, 2.75%. And year to date, Canada came in with 7.36%. The US at 10.25%. Australia at 6.66%. The EU at 10.12%, and the UK coming in at 6.88%. So on the first slide, you can see Canada and the US, and you can see their year-to-date percentages up top. We've got the strategy down below. I won't read that. Everybody will be able to read that in the program for themselves. And then our next slide. Here you can see Australia with their year-to-date and their strategy color guard over the last couple weeks. The EU next, and then the UK. All right, so we'll start going around the world here. In order to do that, I'm going to bring up the Canadian program first. And you can see in the Canadian market, as of the close of Friday, we were actually able to eke out some gains. So we went the other way from the US market, and it looks like, as you can see here, we were really helped out by the energy sector and the gold sector on Friday in the Canadian market. So we do have a market timing gauge needle, one tick into the red, and we do have guidance that reads the color guard is mildly bearish. VectorVest does not advocate buying any stocks at this time. All right, and of course, our market timing gauge needle and guidance is a direct reflection of the top row of lights in our color guard below, where we have 2 yellow lights and a red light. Now, I know we have a lot of seasoned vets out there, but for the new folks out there, I'll do a quick, I won't do a full but I'll do a quick introduction to our color guard. All right, so the VectorVest color guard examines and studies the components of price, RT, and the BSR as they relate to each country's, in this case, the Canadian VectorVest composite price. And here in the color guard, we track these important components day over day and week over week so that we could recognize short, intermediate, and longer term trends in the market. Now, the other thing I'll point out is the color guard is designed to read like a traffic light. You'll see there's green, yellow, and red lights. So it's designed to read as a traffic light. If we see a preponderance of green in our color guard, we know that the market is going up. If we see a lot of yellow, that's a sign that the market is in transition and we should be exercising caution. If we see a lot of red, that's a sign the market is going down or in decline. If we see all three colors, as we see here in the Canadian color guard right now, just over the last week, some people refer to this as the Christmas tree color guard, and it's really a sign of indecision in the market. So what I'm going to do here is, well, one thing I'll cover here first too is, so you'll notice that we have tiles in the color guard here, and these tiles, I won't get into all the rules, but basically these tiles are awarded colors based on market movement. So for a particular tile, if price, for example, was up day over day and week over week, if that was confirmed in both those time frames, it would earn a green. If it was up in one time frame, down in another, it would typically earn a yellow. And if it was down in both time frames, it will earn a red. Okay, there are other rules and nuances, but I won't get into those here at this point. So what I'm going to do is I'm going to expand out the Canadian color guard here so we can see about a 2-week time frame. And in the Canadian market, basically in our color guard here, you can see that we were getting a lot of green lights in our price column, yellows everywhere else. We were getting green lights and they were confirmed by the RT Kicker combo system. Okay, the US Fed raised interest rates here on the 26th. We did get a bit of a reaction on the 27th with a down day there, but it seemed to be a little bit of a head fake. And then you can see we started getting confirmed greens again and yellows in our color guard here, and then transition back after unfortunately the Fitch downgrading announcement. We ended up heading back down to the downside. Okay, but we did finish up a bit on Friday, so that was good to see. Now our market timing, most of our market timing indicators are proprietary market timing indicators here in the Canadian market weren't advancing too well over the last few months. Now, when we did get this final push here, we did start seeing all of these indicators move up fairly nicely. You'll see a lot of similarities when we look at each market here. We saw a lot of the same things in most of the markets. A lot of us in the last couple of weeks, we peaked out on the 31st of July and the 1st of August. And you can see that was the case in the Canadian market. You know, we got to a decent level in our buy to sell ratio, at least of 0.71. Our MTI topped out at 1.08. Okay, but from there, we've seen a degradation in all of our indicators, and we've seen quite a degradation in the BSR, which we don't typically want to see it fall that fast, and that's also common across the board. Now, One thing I should also mention for the new folks out there before I get too far in. So our price column here, price for the Canadian market is basically a arithmetic indexed average price of all the stocks that VectorVest is tracking in the Canadian database. As you can see in Canada, this is 3,245 stocks. And because we track that many stocks, we are able to track the broader market a lot better than anybody else. Okay. And moving on to our RT column, our RT column is actually an indication of the short-term trend of the market. Now it's measured on a scale between 0 and 2. When it's above 1, the short-term trend of the market is up, and the higher above 1 it is, the more intense the move to the upside. When it's below 1, the short-term trend of the market is down, and the reverse is true. The further below 1 it goes, the more intense the move to the downside. And then our moving over to the buy to sell ratio. The buy to sell ratio, so VectorVest provides a buy, sell, and hold rating for each and every stock in each and every country's database. So in Canada here, these over 3,000 stocks will each get a buy, sell, or hold rating each and every day. We then, the BSR is then used. It gives us a good indication of the overall health of the market. Typically when it's above 1, that means we would have more buys than sells in the database, and we would see strength in the overall health of the market because more stocks are taking part in in an uptrend, for example. When it's below 1, as you can see it is in the Canadian market right as of Friday at 0.44, that's a sign of weakness in the overall health of the market because we have more buys than we have, or sorry, more sells than we have buys. All right, so as we look at the color guard here, it's very important for us to notice the transitions. You know, we're watching price to see whether it's going up and down. We're watching the RT, and as you can see, we are coming from a level of 0.6 in Canada. We actually topped out at 0.98, sorry, on the 1st of August. And now you can see we've declined but stayed steady the last 3 days. The BSR, you can see that it was also increasing, kind of dropped off in this area. We did peak out on the 1st of August at 0.71, but we've degraded quite a bit here. And looking next at the MTI, that also improved. We hit 1.08 both on the 26th and the 31st of July, but we're also seeing quite a decline there. Now, when we look at the trend column, our first component of the trend column here tracks the primary wave, and I'm just going to minimize the color guard again here. So the primary wave will be up if price is up week over week. In our case here, it's down in the Canadian market week over week. So our first component of the trend column reads down because the primary wave is down. Our MTI, which is, it combines the trends of price, RT, and BSR into this one comprehensive indicator. It gives us an indication of the underlying trend of the market. And it's also measured on a scale between 0 and 2. When it's above 1, the underlying trend of the market is up. When it's below 1, the underlying trend of the market is down. And as you can see, it's below 1 now. So our second component of the trend column tracks the MTI, or the underlying trend. So in Canada, we're in a down-down situation. You can see we've transitioned from an up-up to a down-down. The last component I'll talk about here is our slowest, most conservative market timing signal, and that's the confirmed call. And you can see in the Canadian market, we are in a confirmed up, and we have been for the last week. Overall, I'm hoping that everybody keeps an eye and watches the daily color guard. out of the US because, you know, in the current market conditions, we have received quite a bit of guidance and quite a few warnings to keep an eye out for things. Now, you know, Angela Akers has done a Get Prepared essay in the last couple weeks. Glenn Tompkins, of course, did his very good special presentation of the week on protecting profits. So we've been alerting, on the US side, they've been alerting folks about the elevated level of the MTI. And the thing to keep in mind in all of the markets outside of the US, for example, myself as a Canadian investor, even though I do invest on the US side, I know when it comes to the Canadian side, I need to keep one eye on the Canadian side and one eye on the US side. Because even if we don't get to toppy levels in Canada, and they're getting to toppy levels in the US, if they do reverse for some reason, like a ratings downgrade, for example, we typically will follow. We may not get to those toppy levels before, you know, they end up turning down and take us down. All right, so important to keep in mind. Let's go now to a market timing graph in Canada. And I'm just going to switch to an MTI layout here. So here we're looking at the Canadian market, and we're looking at a 1-year time frame. The VectorVest graphs are laid out this way. I'm just going to turn off the cursor there. So in the Canadian market, you can see at the top we have the Canadian VectorVest composite that's represented in candlesticks. And in the Canadian market, we have a 65-day moving average that you see flowing through price here. Down below, we have 3 subgraphs for our proprietary market timing indicators, one for the MTI, one for the buy to sell ratio, and one for the RT. So for now, we'll keep everything on here. We'll do a quick look at the Canadian graph, and we'll point out some of the similarities that you're going to end up seeing in the other ones as we go through. So in the Canadian market, year over year, you can see we are higher than we were 1 year ago. We put in a low on the 13th of October, and we got a high, a 52-week high 4 days ago. Okay, if you look at our MTI has spent most of the year below the 1 level. We were actually able to peak up here, which will be important when I discuss one of our indicators. And you can also see the buy to sell ratio and the RT have spent most of this year below 1. Okay, so it's been a very difficult year investing in the Canadian market. Now, if we zoom into the 3-month time frame, so we can kind of take a look at more recent price action. You can see, you know, we hit a low here. Our market was picking up through this area. We were seeing improvement in our indicators here, but we weren't getting enough momentum to the upside to push them as high as we needed them to get. We got a pullback in around here, and then you can see we've got a very decent uptrend running through here, where we did get really good improvement in all the indicators. We were able to see that MTI move up above 1. However, our other indicators didn't follow suit. They got close, but didn't quite follow suit before we got the pullback. And now you can see in the most recent market action that we've got quite a bit of pullback in all 3 of our indicators here. A very important thing that we want to point out, and I'll have to drag just a little bit further back here. I'm going to put a freehand line on, and I'm going to draw a trend line from this point in the Canadian market timing graph. And then we're going to take a look here and draw a trend line down. not just on the MTI, but on all three of our indicators. So from this high of the market back in February, you can see the levels that all three of our indicators, the MTI, the BSR, and the RT, were able to achieve. We had nice upward movement. We had more broadly based support, more stocks taking part in that move up. And also our RT was allowed to get over 1 to very good levels. Okay, recently now, we've made a new high, so our market is higher than it was back in February. However, you can see how we're not getting the same levels out of the indicators. We don't have that same broad-based support. Not as many stocks are taking part in this rally. That you can see from the buy to sell ratios still being at quite low levels, and also our RT. So we're seeing this bearish divergence over this period of time from February to now. In the Canadian market, we did start seeing some slight bearish divergence in the closer time frame, but it ended up being nullified when we hit this high right here. On the US side, they actually do have the shorter term bearish divergence happening in their market. Okay, now taking a quick look through here, I'm going to take a look at our proprietary market timing signals. I'll start with the primary wave in Canada. You could see we had achieved a primary wave up on the 12th of July. However, our primary wave did turn down on the 2nd of August. Okay, and moving next to a DEW. This will take a technical look at the market. I'm going to switch to the enhanced pro trader timing graph layout as well. And let me just take the drawings off that I have on here. So as most people know, but for the new people, the DEW is an acronym. The D stands for the DPO, or the detrended price oscillator. The E stands for the envelopes that you see surrounding price. And the W stands for the 30-period weighted moving average. Okay, the envelopes are there to alert us to extremes in price action, either to the upside or the downside. Since they're not in play, I will take them off just for this discussion. So you can see we are in a DEW up here, and we have been since the 11th of July. One thing's, you know, other warnings we've been getting from the VectorVest system, you can see MACD below, which isn't involved in signal generation, but does add color to the overall signal and does give us early warning indicators. You could see as our market was moving up here, the histogram of the MACD was actually moving down. And you can see how our MACD line and signal line were in bullish formation with a MACD line above the signal line. However, as the histogram narrowed, that was giving us a sign the MACD line was getting closer to the signal line, and we have crossed over and moved into bearish territory now. So that was another indicator that we were losing momentum out of the uptrend here. Now, if we go to our slowest, most conservative market timing signal, the confirmed call, this is one, and I'm going to switch back to the MTI graph layout here. So this is one we were waiting for a long time in Canada. We were in a confirmed down since the 17th of March there. We did get the confirmed up finally in this period on the 19th of July. So that's the status of the market timing signals in Canada. One thing to note is our guidance, of course, is not to buy stocks at this time. And as you can see, some very wise people always told me to pay attention to old tops or levels. So if I put a horizontal line on our graph here, you can see exactly where we are right now, that our market has pulled back to this old top. And really what we want to see with this week coming forward is we want to see, we're in indecision here. We're on a level of support. We want to see if that level of support is going to hold, and we're going to bounce off it and hopefully continue uptrend and in a strong way that'll move our, with a lot of momentum, that'll move our indicators, or we're going to have to wait and see whether we're going to break through that support level and continue downward. Okay, so that's the Canadian market. Let's move over now to the US market. All right, and because I've covered the color guard items in more detail on the Canadian side, we won't have to go into the detail there. We'll take a quick look. I do have it expanded to a 2-week view. And as I was mentioning, you could see over this last couple weeks, the similarities here. The US market did top out in around the 31st of July, 1st of August timeframe. There too, we can see they've moved from yellow color guard, getting some green lights back into yellow. So market transitioning. Another light in the red, or another red light, sorry, in the price column. Then into back to the upside with green, and now we transition back into red. Other than our top 3 lights. So on the US side, their color guard is neutral. Color guard needle is straight up into the yellow. And VectorVest also does not advocate buying any stocks at this time. They finished all down on Friday. Overall, they still have indicators in fairly half decent shape. We are in a down up position, so the primary wave is down, yet the underlying trend of the market with the MTI still at 1.1 is up. Okay, and the slowest, most conservative market timing indicator, the confirmed call, you can see is up, and it has been up for this entire period. But you know, very plain to see how we've started at certain levels at the bottom. We're in an up condition here, started losing momentum, got into a down up, and you can just see the back and forth with the indecision in the market at this time. So if we take a look at a market timing graph on the US side, I'll just get that open here. And we'll go to an MTI layout. So on the US side, you can see I already have the lines on here. You can see with the MTI, the BSR and the RT, we are seeing that shorter term bearish divergence with price going up, and we are losing steam on the indicators. As we mentioned on the Canadian side, we are also seeing that longer term divergence in the US market, longer term bearish divergence. So we are seeing the same thing in the Canadian market here. Okay. Overall, it's pretty much the same setup as the Canadian market. We have pulled back to a level of a previous high. So that is acting as support right now. And just like in the Canadian market, Going into next week, we're going to be in the wait and see mode to see whether this level of support is going to hold, whether the market reverses and continues uptrend, or again, if we break through support and continue to break down to the downside. So again, just a recap there that the market, our guidance on the U.S. side is also that VectorVest does not advocate buying stocks. Okay, so as the setup is quite the same, I think we'll move from the U.S. side now. Let's go to the U.K. market. And if we look at the UK market was also able to squeak and get some gains on Friday. Their color guard is neutral. The market timing gauge needle is straight up into the yellow. And also, VectorVest does not advocate buying any stocks at this time. You can see they had 3 yellow lights on the last trading day, the 4th. And if we take a quick look here, you can see, as I've mentioned, the same trend. Most of our country's markets seem to top out with our indicators in around the 31st of July, 1st of August. And each one of them, you can see in the UK, their buy to sell ratio was able to hit 1.50, and already just 4 days later down at 0.89 level. Now they did get quite a bit of increase in the buy to sell ratio between the 3rd and the 4th. However, if you take a look at the MTI lost ground in that same time frame. They are in a down up situation, and the slowest, most conservative market timing signal, the confirmed call, is also in a confirmed up. But in the UK, you can see how they were in a confirmed down just around 2 weeks ago, and were able to move to the confirmed up. So let's take a look at a graph on the UK side. Okay, so as you can see, the graphs are looking quite similar. Now in the UK, let me take the crosshair cursor off. They haven't, it looks like they initially pulled back around this old high here, but they've broken down below that and have basically broke down into this level. So that's the level we'll be looking out for in the UK to see whether that level is going to act as a good level of support for them. And again, be able to resume uptrend, or whether we continue to break down and move down to the downside. Now, if we take a quick look here, I'll put a free hand line back on. It's a little bit of rinse and repeat, but there you can see the very same bearish divergence we've been talking about. Also showing itself on the UK market, as the market has put in a new high of late. Our indicators haven't. All right, and then a quick look through. Let's start with our fastest, most aggressive market timing signals. So the primary wave, you can see they did. They've been getting some whipsawing. They got a primary wave up back here, but in recent times they got the down on the 26th. They got an up. Looks like the very next day, and then they got it down again on the 2nd of August. Okay, so they're in primary wave down. If we take a look at the DEW, they are still in a DEW up. I'm just going to quickly switch to the Enhanced Pro Trader timing graph layout. And all I wanted to see here was whether they were seeing the same divergence we were seeing in Canada. And as you can see, the MACD histogram was moving down as their market was continuing to move up. Okay, but they remain in a DEW up for now, and they got that up on the 18th of July. And as we pointed out on the homepage, when we look at the confirmed call, they were in a confirmed up, and they had got that confirmed up on the 24th of July. Okay, so same guidance on the UK side. VectorVest does not advocate buying any stocks. We do have the market pulled back to a level of support, and we'll be waiting patiently to see how things evolve in the next week of trading. All right, so next we'll go to the EU. So in the European market, they also were able to realize some gains in the market on Friday. Their market timing needle gauge also straight up into the yellow. Their color guard is neutral, and VectorVest does not advocate buying any stocks at this time. Very quickly, we'll see that they also topped out as far as our proprietary market timing indicators go in the color guard, topped out in around the 31st of July, 1st August timeframe, and have seen a breakdown from there, but it looks like not to the same extremes as in some of the markets, but you can see the transition in all of our indicators, including the MTI, right from 1.40 to it looks like a high of 1.48 right in that time frame, and it is losing quite a bit there, down to 1.18 now. The EU is in a down up situation, so the primary wave is down, but with the MTI above 1, the underlying trend of the market is up, and their slowest, most conservative market timing signal, the confirmed call, is also in a confirmed up and has been through this period as well. So if we take a quick look at a market timing graph on the European side, we'll just wait for this to come up. And I do see a comment about the UK market magic trades. The UK market has been seriously lagging the US market this year. Our market has been very choppy and non-directional, and definitely that's the same can be said for the Canadian market as well. So our market timing graph in the EU, if we quickly put a horizontal line on here, we can see that the same story is true. The market has gone up quite nicely here. We've had, choppy but good movement in through this area to the upside. However, we have pulled back to some old tops that are acting as support. So we're in the same wait and see game here with the exact same guidance. They also have their 65-day moving average here, providing a level of support as well. And I won't draw the lines because I'm pretty sure everyone can see at this point, but if we look at the MTI, we look at the buy-sell ratio, and we look at the RT, you can see that very same bearish divergence from the February timeframe into now. Okay, and then taking a quick roll through our proprietary market timing signals. Let's just go to 3 months on this one, because we have got some whipsaws here on the primary wave, but you can see they are in a primary wave down since the 4th of August. If we look at the DEW, they are in a DEW up. And they have been since the 12th of July. And you can see in the EU market, they weren't quite seeing the same divergence that we were seeing so far in the other markets when it comes to the MACD and the histogram. Okay, and lastly, let's take a look at the confirmed call. And they have been in the confirmed up since the 12th of July in the EU. Okay, lastly, we'll quickly move to Australia. So it looks like Australia finished Friday mixed. It looks like their indexes were up, but the VectorVest composite was off a little bit. Their market time engaged needle is 1 tick into the red. Their color guard is mildly bearish. And yet again, VectorVest does not advocate buying any stocks at this time. If we look at their color guard, you can see again in the 31st July, 1st of April timeframe is typically right in that area. For them, it looks like, yeah, the 1st of August, the BSR hit its highest level, 0.96. And like the Canadian market, theirs has fallen off pretty quickly as well. They are a sector and commodity-driven market, much like ours. So overall, we can see all 3 colors again in the color guard. We can see they were able to get a lot of green lights in the price column as well. But we are in a indecision and transitioning market here. They were able to achieve 1.15, 1.17 on the 1st of August in the MTI, but it is degraded as well down to 1.05. So they're in a down up condition. Their primary wave is down. The underlying trend is up, seeing as how it's above 1. And the confirmed call is in the confirmed up. They were also down initially in this 2-week time frame, but switched to up and have been able to maintain it. All right, so we'll take a quick look here at the timing graph on the Australian side. And this has really been an exercise of rinse and repeat here, folks. As you can see, again, we've got a market that has pulled back to these old tops, and it's interesting how that February old top has become important to all of us in every one of the countries. So no different guidance here. We're in a wait and see mode where VectorVest is not advocating buying stocks. So we're in a wait and see mode to see if this is going to act as a good level of support, whether we get the bounce or the breakthrough and continued downside. And in the Australian market, you can see with our proprietary market timing signals, you can see how good they are at showing us this bearish divergence coming from that February timeframe and letting us know that you know, we need to be cautious. We need to keep our head on a swivel, and we need to make sure that we stay fleet of foot here when making any decisions to enter the market. Okay, and as I said, ensure to keep up with the daily color guard on the US side. Whether it's a market you trade in or not, there is very valuable guidance given there that typically will apply to every one of the other markets. Now, the last thing I'm going to do here is I'm going to take a quick look just from a market timing graph perspective. We'll look at the primary wave. They're in a primary wave down, and you can see they've been in that primary wave down from the 3rd of August. If we look at the DEW, so they've been at a DEW up since the 13th of July. And as you can see in the Australian market too, they got quite strong market movement here. It doesn't look like a divergence happened with the histogram there. If it did, it would be very slight. And lastly, on the Australian side, let's take a look at their confirmed call. So you can see they got the confirmed up on the 24th of July and remain in that position. And for all of our American friends out there, don't worry. I do realize I ripped you off. I didn't look at your indicators on the US graph, so I'll jump back and do that lastly before I turn things over. I got a lot of graphs there, so I'm going to open a new one to make sure I've got the US graph. And let's take a look at our primary wave first, our fastest, most aggressive. So on the US side, you can see the whip sign in the primary wave that was down here on the 25th of July. They did get an up on the 28th of July, and then right back to a down on the 2nd of August. Okay, and taking a quick look at their DW. Okay, the DW up they got was on the 2nd of June and continue in that DW up condition now. But you can also see on the US side as the market was pushing up, they were getting the divergence with the MACD indicator down below. And lastly, the confirmed call. And the US actually did get a whipsaw on the confirmed call when they received that confirmed down on the 6th of July. But very quickly on the 11th of July, it turned back up and they remain in the confirmed up today. So all of our markets look like we're in the same condition. VectorVest isn't advocating buying any stocks, and we are in a wait and see mode as all of our markets have turned and pulled back to an old market top, a level of support that we'll wait and see whether it will hold or whether we break through and continue to the downside. On that, as they say, Glenn, in your favorite sandwich shop, that's a wrap, and it's over to you.
There we go. All right, I have my mic muted. Sorry about that. All right, so thank you for that, Rick. And that was really deep and entailed, and I think that everybody in VV Nation had to have appreciated that. That's what you call going above and beyond to make sure everybody knows where they stand within the market, no matter where you are. And I love that we do all of the work for them, and all they have to do is reap the rewards. And pointing them through step by step, I think, was an integral part of everybody now being on board with the guidance. Recently on the YouTube channel, I found a lot of people still saying that right now, as the market is pulling back, this is a buying situation. I'm like, not yet, folks. We're starting to move down, coming off the July high, coming off the credit cut. There's so many things that are giving us more insights to more down markets. And every market in the VectorVest software is showing more cautiousness, not to buy stocks, as you showed on every guide. It was saying that this is not the time to buy. Not yet. And if, everybody wants the market to go up. I totally understand that. But let the market come to you instead of trying to will the market in your direction. You're going to lose each and every time. Each and every time. So the guidance is there across the board. And I'm going to touch on the things that we need to do in the present market's condition to help us to do what we need to do. So I'm going to start off with, where do you put your money? All right, and let me go to here. I'm going to share my screen. Where do you put your money? All right, and hopefully everybody can see that. And I hope, say again? You see it. All right, so with that being said, we always want to talk about gold. Gold is a commodity. Gold is a place that a lot of people can make money. And I'm going to start off, I'm going to cover, for the sake of time, I'm going to only cover 3 countries, the US, Canada, and the UK. All right, I'm going to cover those 3 countries. I think Rick has done a great job, as I mentioned, about covering everything that you need to know about Australia and the EU. But for the standpoint of gold is either moving or it's not. So I'm looking at right now, let me move this over, Joey. There we go. I'm looking at right now the Huey. This is what we use along with the Midas Touch graph. The Midas Touch has done a great job in getting us in and out of gold at the right time. All right. We've got moving averages on the stop price of the Huey, which is the gold bugs, and moving averages on one moving average to smooth out RT, the 40-day moving average of RT. All right, good opportunities to buy early when the 5 and the 40, the 10 and the 65 of the stop price of the Huey hit. Boom. All right, more confirmation. Let's wait for the 40-day moving average of RT to go above 1. Is that coming late to the party? It's coming later to the party, but do you still have the opportunity to ride gold up or down? And the answer to your question is yes. Where are we now? Well, the 5 and the, sorry to get the 5 and the 40. I got 2 different graphs mixed up in my mind. The 10 and the 65 of the Huey right now, the 10 is below the 65. Not a good time. More confirmation, the 40-day moving average of RT below 1. And he said, well, wait a minute. It went up. Sure it did. But look, the 10 is still below the 65 and following through. So from a gold perspective, not the right time to be in gold in the U.S. market. So now I had to think a little bit. Where should they be when it comes down to getting into the market right now? The biggest thing I'd like right now, let's go to the viewers tab, is petroleum. I'm at the sector viewer right now. Sector viewer 1, 2, 3, 4, the 5th highest viewer right now in the sector viewer, and we got 41 sectors. The 5th highest in the viewers right now is petroleum. Notice that on Friday, it went up the most, okay? So then I said, what's going on with oil? Well, within oil, we know that OPEC is cutting back. Russia, who's putting out all this oil, blah, 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 blah. All of the people who are the big players in oil are cutting back. The demand is still the same, but they're cutting back on the supply, which should drive oil higher, all right? Which should drive oil higher. And as I looked through these 3 countries, I think the same story was being told in all 3 countries. Could I buy the Huey from Europe? And the answer to that is I don't think so. And honestly, in the EU, either the UK, actually rather the UK, I want to know, is there an indicator that David had for the Huey or looking at gold? If anybody could put that into the room, it'd be greatly appreciated. It would be greatly appreciated. All right, so petroleum is high, high amongst out of the top 41. It's number 5. All right, so what did I do? I right-clicked and I looked at the stocks that were in the petroleum space, and I came up with some stocks for you. Let's go to the watch list viewer. Let's go to the IUG. I created a watch list group. I came up with 3. Let's go make sure this is auto fit. Came up with 3 for you guys. TDW, USO, WTI. Notice that all 3 have RTs above 1. USO is an ETF, so it's got no earnings growth. WTI, undervalued, negative earnings growth. That does catch my attention, but you know, you've heard the story. The rising tide floats all boats. All right, GDX. Thank you, Chris. GDX. I'm going to use that today. How about that? All right, GDX. All right, so from this perspective, an industry or sector that's hot is oil. If we look at graphing these 3 stocks real quick, put these on a 3-month graph, TDW, and this is my setup. Actually, no, this is still the Midas Touch setup. Even from a Midas Touch setup, TDW, good play. Little pull off on Friday, but right off the 3-month high, and look at the rise of the 40-day moving average of RT. Wow, USO. Now, what I do like about this is that it is rising. It is rising from a Midas Touch perspective. The 10 has crossed above the 65. You know what would give me more confirmation? When this RT goes above 1. That's the 40-day moving average of RT. When it gets above 1, man, this could pop. How about you could get into it early? Well, are you coming late to the party after the 10 and 65 have already crossed? No, I don't think so. I think there's still got more upside to oil. Boom. I like that. And then last but not least, we have WTI. More of the speculative play by way of the Midas Touch. The 10 is below the 65. It is starting to rise. The 10 is below the 65, and the 40-day moving average of RT not quite above 1 yet. This is more of the speculative play. All right, but stronger plays, I'm looking at USO, and the strongest play, I'm looking at TDW. Do you agree with those? Type of 1 if you like those plays. All right, no matter how you play the market, whether you're more aggressive, more prudent, actually, this would be my more secure stock, this would be my more prudent stock, and this would be my more aggressive stock. Folks, I got you covered all the way around in this space. I got you covered all the way around in this space. All right, now last but not least, so we looked at gold, not the right time. We're looking at oil, getting you some plays. The last thing I need to look at is where do you think the best place is to play the market right now? All right, Les is going to talk a lot about this, but where do you think the right place to be in the market right now? All right, outside of oil, outside of gold, what's a good way to play the market to the downside? I want to see what you got to say. Is a chart reverse at RT40? Steve, I'm going to take a look at that, but probably not now. I got to get through this. Got to get to our there you go, to our special presentator. Michael is right. Copper, I like as a commodity, especially because of our EVs. But Michael hit the nail on the head. I would go to ETFs. I would go to buying contra ETFs. You know what I would do? There's a simple way. Let's go put this on 20. There's a simple way. The simple way is just to run the search, right? We're going to take it a little further. Simple way, run the search. Why not do this? Let's jump on the RTs. Let's see if we got RTs greater than 1. We do. Look at that. We've got 2 with RTs greater than 1. I would concentrate on those. I would definitely concentrate on those. All right. But if I go sort back by VST, let's let the search do the work. All right, let's let the search do the work, and let's go see what else is up here. DRV, real estate, that makes sense. A lot of people not wanting to build new homes, even though people are. They don't want to refinance a brand new home, so they're staying in their homes. Real estate is an issue. How about we change this by, percent price change? Which one's moved up the most? AAPDT. Folks, any which way you want to look at it, we're going to help you to hone in, depending on how you invest, what to do. Not the SVIX. No, you're right. I would look at the UVIXI. All right, but the SQQ is also a really good play to play as well. All right, so for the U.S. market, we looked at gold. Gold is at a 78% retracement from the March low to the most recent high and is a double bottom. I would think Dr. Paul would have been all over gold as a play to the upside, missing David Paul. You know something? When we go look at the UK, let's go look at it there, Don. Yeah, it is on a retracement, but if you looked at it from a Huey perspective, ain't the right time. In the UK, it could be telling you a different story. So we're going to look at the UK as well. All right, let's go to the next country, which is Canada. Let's start off by gold here. Again, even Don, and Don, I'm with you as trying to get into gold at the right time. Now this is the second country in a row not looking good for gold. I don't care about the retracement. I care about what we can do to get in at the right time. And that's the beautiful thing about VectorVest. We take the noise out from everybody else. We make it simple. And you know something, Don? For the most part, we beat out what everybody else is talking about. Here's the last opportunity. And I hear the retracement. I hear all of that. But let's talk about that. Let's go put on, does this system work? Here's the crossover. Here's the RT. Was that a buying opportunity? Abso-freaking-lutely. When it goes below, and again, and not to downplay anybody, but sometimes I get tired of listening to everybody else. How about let the system do the work for you? Here's the crossover to the downside. Here's the follow-through. Was that a good time to be out of gold? Abso-freaking-lutely. So I'm all about listening, trying to imply or listen to what other people have to say. But when we get to the UK, it could be telling me a different story. All right. So for the Canadian market, not the right time to be in gold. All right. As we can see, not the right time to be in gold. So let's talk about on the other side, what's the hot industry, hot sector? Petroleum within the top 5. Once again, not the biggest mover for the day. All right. Phil says, as a Canadian, instead of gold, I bought the US dollar at a low. Nothing wrong with that as well. I've done a couple of videos on the US channel, on the YouTube channel, specifically talking about the de-dollarization. If you want to look and learn more about that and how the VectorVest software looks at that, by all means, please check that out. 8-period stochastic. He usually liked it with both the daily and the weekly. We might take a look at that as well, Chris. All right. This American likes his coffee. You know something? I didn't even make none today. It's empty. Oh, Joey showed the picture. I ain't even make none today. My coffee cup is empty. This is just on the hype of just being here. I love being able to talk to you guys. So let's go. There you go. The top, and amongst the top 5 in petroleum, amongst the top 5 in the sector is petroleum. I made a list. Let's go look at the watch list that I made. IUG for the Canadian market. Here's 3 that I made. All right. Undervalued. RVs all above 1. Earnings growth all above 1. Either a buy or a hold. CIs all above 1. I think if the sector is on the move, then these are some stocks for you to keep your eyes on. Let's go AutoFit. Man, I love the earnings growth. I love, not all of them have a relative safety above 1. Not all of them have RTs above 1. But I love the upside potential, especially knowing that the supply of oil is kind of poopy. You buy miners like MMT or Gold Index. Akshaya, I'm all right with buying the miners, but a lot of times they don't always go in tandem. Not always does the gold and the miners go in tandem. Sometimes they go separate. I didn't look at the miners. I specifically looked at gold. But, and there we go. Nigel says, for miners, GDX not available in dollars on all platforms. Alternative is GDGB. GDGB. All right, maybe we'll look at that for the standpoint of the Midas touch for you. People say safety first. That's not true. Coffee first. I got you. I didn't make coffee today. I only had one. I took my wife out to breakfast before I came today, so I had coffee at the restaurant, but it wasn't Cafe Bustelo. All right, so from the oil play, these are the stocks that I like for you in the Canadian market, and I still have them on the Midas touch. Man, look at that. Look at the crossover backing up. There's the crossover 1065, and I don't mind keeping the Midas touch, even on the oil plays, to help to emphatically say that this is a good way to make market money in the current market's condition. Let's look at the next one. Wow, EFX. Any of you in Canada trading any of these? Wow, this one I'd watch. This one I'd keep my eye on. It looks like it could be a bearish divergence between RT and price. But anybody in Canada trading any of these from a petroleum perspective? Now, there's a lot more you probably could trade, but I'm only looking at, I only picked three. For the sake of time, I just wanted to get you, I wanted to wet your whistle. I wanted to wet your whistle and at least put you in the direction of what's making money in the current market. Not those, but trading many, says Joan. Excellent. All right, so maybe these are three others that you can keep your eyes on or add to your portfolio. All right, and last but not least, let's go to the Unisearch. Let's go to ETFs. Let's go to country ETFs. Let's run the search. Same kind of scenario. It's not a lot in here, all right? Not a lot rocking and rolling. But I would probably pay attention more so to the ones that have RTs above 1. All right, and that's gold. Look at that. That's the opposite. So again, wow, that backs up what I was just saying about gold, that it wasn't the right time to play gold in Canada. Bingo, that one of the top contras in the Canadian market is a gold bearish ETF. Bada boom, bada bing. I couldn't have scripted that better. Again, and I'm going to go back to what Don said. Again, you can do and tell me anything you want, but I'm going to use the power of the VectorVest software, and that's why you're subscribers to the software. You pay for the information that we give you. All right, and yep, so that covered the Midas touch, that covered the oil, and that covered contras. Let's go to the UK market. And which one is this one? This is the UK market. I needed a symbol, but I'm not going to do that. Yeah, I needed that for the Huey side. Let's go with GDGB. I don't have that. Sorry. Let's go to GDX. All right, I am in the right market. Let's go to GDX. GDX. That's the miners. That is the miners, right? GDX. There's the gold. GDX.L. Gold. All right, is that what I'm looking for? NRGU. In which country, Drew? Because now I'm in the UK. It's the ETF. Is this the one for the UK that you guys want to use? Because I did not find out the right one for the UK. All right, so I was going to go off of your suggestion. Let's go Midas touch. Yes, Bob, waiting for USA. No. Oh, that's for, okay. GDGB is the UK, but I don't track that. All right, so I'm putting it wrong. GDGB. I do have, but it's the miners. All right, so Nigel says GDGB, the UK side. We'll use it. All right. Now, let's go back to what Don just said about the retracement. Someone else said that Dr. Paul would be all over gold. I don't see it. By way of this setup, I don't see it. I do see the last time we had an opportunity. Oops, let's go put on there. There's the L. I do have the L up there, Chris. There's the L. It's GDGB.L. There's the L. This was a good opportunity to be in. It dropped down real quickly and gave you another opportunity right about here to be in, right about here. Right now, I don't see it. So, Don, you know, I appreciate a lot of the things that you say. I'm going to use the power of the system that we have specifically to track gold to say that this is even in the UK. This is not, and Nigel agrees, not yet, he wouldn't. And I'm with you on that. But when the time comes, the Midas touch setup will get you in at the right time. Not the right time to be in gold in all 3 countries. All right, let's go back to the viewers. I did the same thing. I went to the Unisearch. I did it a little differently in the UK. I did a 10-day RT delta on sectors. 1, 2, 3, 4, petroleum, top 5. Not the biggest mover on Friday, but you'll notice that petroleum is in the top 5 sectors across all 3 countries. That says something. So I did the same thing. I went through the petroleum. I went and I found, let me make this a little bigger. Layout, this one, 18. Okay, there we go. I found 3. 3, and let's go put the values over here. Let's go look at the relative values. Big play for me. If I'm going to play oil, I want to have the oil companies that are going to perceivably outpace the market. RVs of all of these are all at 1.4 and higher. They're all in uptrends. Look at all of their earnings growth rates. All right. Glenn, so I got you, Bar. For both of y'all, Chris and Barclay, you did see I had the L for the GB. So we did look at that. Let's go graph these real quick. No, I don't want a quick test, Glenn. Hello. Let's graph these all. And again, I still have the Midas touch layout on here. Woo. AT.L. I'd be careful. The 10 and the 65. The 10 and the 65 look good, but I'm watching RT. Still above 1, but I'm watching it. I'd be careful with that one. This is SEPL.L. I like it. And the last one in the UK, this could be the more aggressive play because the 10 is not above the 65 and RT is not above 1. But remember, I didn't run these off of the Midas touch. I'm looking at the Midas touch graph after I looked at and found the ones that I wanted to find. This is the more aggressive play. All right. So with everything that Rick put together, which again was an outstanding presentation of all of the countries, I've now come behind him to tell you where you need to be. Gold is always hot on everybody's mind. Is it the right time to be in gold? I've shown on all 3 countries. I don't care about a retracement. I don't care what nobody else says. Personally, I want to use the power of the software. Personally, I want you guys to depend on the power of the software. We will let you know when it's the right time to get in. We know what's going on with oil. I've given you the opportunity in all 3 countries to look at stocks to play as an oil play. And then, last but not least, when you go to the Unisearch tool and you go to try to find ETFs in the UK market, couldn't find it. So what I will do, let's do this. Let's go to searches short. I don't know, and this is where I fall short. I don't know how shorting works in the UK. But I would go through from the most recent primary wave down. I would run these searches to find out which searches have the best stocks that are going down. That would be my guidance to you in order to find stocks to play to the downside. All right. And again, I'll admit I do fall short on knowing how the downside works in the UK market. But from that perspective, we here at VectorVest still have searches that you can find to either play the options on the buy the puts or the sell short. And there you go. All right, now I'm done. Hopefully that was insightful for you following what awesome job Rick did in, meticulously going through each and every one of the countries. This is, I think, it just puts the cherry on top to use that information and put it into practical application. All right, with that, all right, let me get you over to the creme de la creme for the day. The big speaker for the day, Les Masonson, and he's going to go deeper into the world of ETFs. I did cover just a small portion of it to help you to take advantage of what's going on right now. But Les is going to take us on a journey through the power of ETFs and how they work. So with that, Les, I'm turning it over to you, my friend.
Okay. Okay, thank you very much. Is my picture on there? Okay, I'll leave it on for a few minutes. Good afternoon, everybody. It's a pleasure to be here today with you to cover one of my most favorite subjects, which is exchange-traded funds. This is a product it's one of the most innovative financial products that have come out in the last 30 years. So it's something that you should be very well aware of and really take a big interest in, since it's an important subject and one that will help you achieve many of your investment goals. So, and we also will have time at the end for a Q&A. What I'd like to do is first introduce myself to you, and then I want to cover some of the basics of ETFs, how the ETFs originated, what their growth was, the different categories of ETFs, the risks and rewards of ETFs, active and passive ETFs, leveraged ETFs, and then we'll go into the Q&A. So I'd like to start the presentation now and keep moving along. So please put the presentation on and remove my picture at this point so we have a full screen. As far as my background is concerned, I've been trading the markets for over 20 years, mostly triple leveraged and NASDAQ. It's a tough thing to do. It's really simple, but it's very hard, to say the least. What I've been doing since 2016, I've been an ETF columnist and a contributing writer for Technical Analysis magazine. I do interviews. I've interviewed about a dozen top traders and technicians. And I also do software reviews. I've done 2 reviews of VectorVest software in November and December of 21. I have 8-page reviews of the software, and it was really a pleasure to do that. I was a financial advisor for about 6 years with the company shown there. And for 65 years, I've been involved in the market, learning about it, researching it, and analyzing it, and using technical analysis techniques. In 1989, I was elected to the AMA Wall of Fame because I was involved in the area of corporate cash management for 27 years prior to getting involved in the investment arena. So I taught courses there, and they came out very well, and it was a pleasure working for them. I did get my master's degree in 1970, a long time ago, but I focused on relative strength, and that's where my interest in the market even enhanced even further. And of course, I have a bachelor's degree in finance and investments, and I have authored 6 books since that point, and my library itself, it consists of over 500 books, which I really focus on time after time. As far as the books that I've written, starting at the bottom, I wrote a couple of books on cash management when I was in that arena and worked for the banks. And then I started with my day trading book in around the 2000 time frame. And then I focused on market timing, which I feel is a critical element to success in the markets, even though 99.9% of all Wall Street tells you that it's not the way to go. It's time in the market that counts, not market timing. I disagree 1000% with that, as I've shown in my two books. One was a second edition. My last book was Buy, Don't Hold, and that was showing individuals how to invest in ETFs using the relative strength concept. So I'm heavily focused on relative strength, on technical analysis, and evaluating the markets using rule-based investing. So the focus of today's presentation is on exchange-traded funds, and let's go for it. In the beginning, the first fund actually was developed in Canada in 1990. Most people are not aware of that, but the first one in the US was the Spider Sector, came out in 1993, and most people were not even aware of it for the first couple of years, and it didn't have much play in the markets, and certainly financial advisors were not using it or even recommending it because they had their favorite product called mutual funds, where they got a terrific benefit, financial benefit, by selling active mutual funds with loads between 5 to 8%. So they really racked up in those days. The first leverage fund didn't come out until ProShares came out in 2006 with 6 ETFs. And the first spiders, which are the select sectors, didn't come out till 1998. So that's what happened in the beginning. As far as the growth of ETFs, as you can see in this chart, between 1993 and 2005, there was minimal growth. The graph is almost flat, but then you'll see starting in about 2009, the graph took off, and we're now at a level around $7 trillion in assets. So it really mushroomed over the years, and the interest of stockbrokers, financial advisors, and institutions has been terrific. As far as the growth of ETFs, you could see on the chart, the table in front of you, there are 1,930 index ETFs, or the passive models, versus 1,000 or so of the actively managed models. And you could see that the active management ETFs have really increased in market share over the past 10 years. And certainly since 2017, there were 11% of the total of ETFs. Now they're at 36%, and they're growing even further. So that's where the action is. Believe it or not, many more active ETFs are coming out than passives in the past year or so, which is pretty amazing to me. And especially in the bond arena too, there's been a great interest in bond active ETFs because they feel the managers there have an expertise that can't be duplicated by doing it yourself. One question is, why even bother investing in ETFs? Well, the two major reasons are intraday pricing. The ETF is priced like a stock during the day. It trades during the day and even after hours. So that provides you with an opportunity to execute a trade at any time you desire. Another critical factor is the area of transparency, where the ETF portfolio is available to be seen each night as to the current status. So you don't have to wait a month or 3 months like in the old mutual fund days to see what's in the portfolio. And the queen of transparency is Kathy Wood at the ARK funds. She shows her entire portfolio every day in all the 8 ARK funds. So anyone can track her performance, and certainly it has had a roller coaster ride since she began her ARK funds years ago. The other reasons for going into ETFs are shown on the slide. They're probably very well known by you. But one key there too is there are 3,159 choices you have. And you can also now buy inverse ETFs, which means that you don't have to go short and borrow money. The key points about ETFs are they're mostly passive and active. You have two main categories overall, and the actives are really coming heavy into the marketplace, even though the statistics show that the active managers over 20 years in portfolio in mutual funds, about 85% do not beat their benchmark over 20 years. So even that being the case, and that being the fact, the sponsors of ETFs are coming out with active funds, and they're getting, in some cases, a high percentage of individuals investing in them, especially on the fixed income side. One thing to note, of course, is that you need a brokerage account to purchase an ETF. The characteristics are most ETFs follow a benchmark. It may not be a common benchmark, but there's so many benchmarks out there. They select the one that they choose. The money is 100% invested in most cases, although in some cases, they're in the active funds, they have discretion to even to go to zero based on their prospectus. They're allowed to do that. In most cases, the securities are not changed much because they're an index, low portfolio turnover. And usually the passives beat the actives when you're comparing apples to apples. They also focus on a specific group of stocks. And you don't need a star manager to run an ETF because the index takes care of itself. Now, as far as who is running the show and who the biggest sponsors are, there are some big names, as you can see. BlackRock is at the top with their iShares, and next is Vanguard and State Street. If you take those three together, they comprise currently about 78% of the total assets under management, which is in this slide, it's 6.9. It's about a month older to this slide. So those top three control 78% of the assets. And if you look way down, you can see you have Fidelity down here at 33 billion. Fidelity was late into the game. It's interesting to note that Fidelity didn't come into the marketplace as far as ETFs until 2003. So they were 10 years late, and they didn't really produce a lot of ETFs. Currently, they have 59 ETFs, a few more than listed here on the table, at a value of about $37 billion. Compare that to Vanguard, which has 82, and they have $2 trillion. So Fidelity missed the boat for whatever reason, and Vanguard did well, even though John Bogle, when he was there, was a person who really wasn't focused on ETFs. But the next chairman, John Brennan, was, and he brought the ETF world into Vanguard, and they've benefited ever since. ARK is even here because of the tremendous interest and the performance up until February 2020 with 16 billion in assets, but they were up to probably about 28 billion at a prior point. As far as the top ETFs based on assets, you would expect to see the S&P Spiders up on top, and then there are duplicate funds from other vendors, Vanguard and the iShares. Number 4 there, or 5, is the QQQs. So you have these assets, they're competing against each other, and they're all breaking the market apart and sharing a portion of the market themselves. Gold is down here near the bottom. So you can see it's mostly indexes for the most part. As far as the capitalization of ETFs are concerned, we have the standard 3 categories that we have in the markets: large cap, mid cap, and small cap. And we even have micro cap, smaller than the last category there. As far as the weightings are concerned, the indexes are weighted in certain ways, usually 3 different ways. They're either market cap weighted, they're price weighted, like the Dow Jones Industrial Average. That means the highest priced stock has the most weight, which is a strange way of doing things. So a stock that's $400 will have a 10 times the weight of a stock that's $10. And then you have the equally weighted ETFs, where there are 126 of those. The famous one is RSP, the S&P equal weight. Sometimes the equal weights do better than the market caps, and sometimes they don't. It varies over time. As far as the cost of ETFs, there's an internal cost. The mutual fund portfolio managers trade their portfolios in the active cases, and the portfolio turnover may be a couple of 100%. There's also the cost of the bid to ask spread. When you purchase an ETF, there's a bid and an ask price. Hopefully the difference between the two is a penny or so. In some cases, it's much higher when the ETF has less liquidity and less interest by the public. And there's also a critical factor called the annual expense ratio, which takes into account the management of the fund. And typically the passive ETFs have a lower fee than the actives. Now, what did the fees look like? Well, here is a table showing the annual expense ratio since 2017 through 2022. And you could see that in the equity case on the left side, the ratios are declining over time. And you can see the most expensive expense ratios are for the geared ETFs. That's a fancy name for the leveraged ETFs. So those are typically between 0.95 and 1.05% a year. Equity ETFs are the least expensive. There's a whole bunch of them that are 0.03 to 0.05. And then the alternatives are in between the asset allocation and the geared. As far as the costs are concerned, additionally, there are brokerage commissions for trading ETFs. However, since most brokers are now commission-free, that is not a consideration to worry about. And there is a variance in the net asset value between that and the price, and the intraday changes in the price. It may not be exact. And they also have securities lending fees, where the ETF tries to bring in some more money by lending out shares to people who want to go short. Some of the risks of ETFs are, well, they own companies, and companies that may have difficulties would decrease the value of the portfolio. Some portfolios are heavily concentrated in maybe 20 stocks. So if that particular sector or group of stocks has a problem, it can be a much worse performance than the rest of the market. Another risk is the bid to ask spread on inactive securities or inactive ETFs. It can be 5 cents or more for the spread. There's also country risk, depending on which country it's in. Over in Europe and Asia, things are not that stable. There's also currency risk. So depending upon the type of ETF you have, you may have those types of risk as well. And shares may not be available for shorting, and the shorts could be called prematurely. Some more risks: the stock market fluctuates. So ETFs, like any other investment, has a volatility built into it. And sectors, industries, and businesses have another element of risk, because certain sectors do well over time, like energy, and certain times they do terribly. I remember looking at a table of performance over the years. Energy was on the top performing sector for years, and then it's on the bottom, and now it's moving up again. And of course, you have the global risks, political, economic, and social. And one thing you don't want to have happen to you is have a black swan event, an unexpected event that can cause havoc in the markets. We've had them in the financial crisis. We've had them in the flash crash and many other situations, and it really creates havoc in the markets. Here's a continuum of the risk versus reward spectrum. Of course, bonds and CDs and dividend stocks on the left bottom are the least expensive. And as you get to the top of the chart, you have the cryptos, small caps, penny stocks, futures, options, and commodities. And they should have leveraged ETFs all the way at the top as well. As far as the categories of ETFs, you can spend weeks reviewing all the ETFs categories. There are a huge number of categories. That's one of the beauties of ETFs. You have a wide choice of what you want to invest in, and you can add slices of the market that you couldn't normally do when you had mutual funds. And I put on the screen about, let's see, about 16 on the screen, different categories. And that's not the only one, because I have another screen with more categories. And some of them you may not be familiar with at all because they're fairly new, such as single stock ETFs. There are ETFs on single stocks such as Tesla, Amazon, Apple, among others, which have been put out recently by some of the sponsors, and they're doing very well. You have buffered ETFs, which limit the risk on the downside and on the upside, and all the others listed on the slide here. As far as the factors, ETF factors, I've listed 8 of them on this particular slide. The most common ones that people invest in are value, size, momentum, quality, and yield, and volatility as well. There's specific factors that focus on certain segments of the market. And of course, you have to realize that at certain times, value does better than growth, and small cap does better than large cap. So that's why market timing is critical to determine which to be involved in. As far as the risk is concerned, as you can see on this slide, volatility on the bottom, total return on the top, high beta ETFs, which fluctuate more than the market, are most risky. On the left side, the low volatility and the high dividend stocks are the ETFs are the least risky. As far as themes are concerned, there's a huge number of ETFs that are based on themes. And I've listed some of them here. This slide I took on Wednesday after the market declined. I think the Dow was down about 300. I wanted to show you the impact of the market decline just on these particular themes. And at the bottom, ARKK lost almost 6%. And the safest one in this particular listing was the water ETFs, down about 0.05%. So this is just to show you the types of themes that are out there, and there are others as well. You're probably familiar with some of these. Some of you may have slices of this in your current portfolio because you like cannabis or big data or fintech, whatever. But there's a huge choice here. Now let's speak about passive ETFs for a few minutes. The passive ETFs are the most common, 1,900 of them. And the most common, of course, the S&P, Dow, and the NASDAQ, but there are many other indexes out there. Fixed income, small cap, large cap, micro cap. And these have very little movement during the year. Not much management is needed. There are replacements. If the S&P 500 has a replacement of older shares of certain companies, they replace them with new ones, but that's about it. So these have the least annual expense ratios. The top passive ETFs with their tickers are listed on the slide in front of you. And as you expect, the SPY, the S&P 500, and those are the number 1, 2, 3, and 4. VTI, Value Line, Total Stock Market, QQQ, NASDAQ 100, et cetera, et cetera. You can see most of them are well-known indexes, bonds, total markets, and slices of the market. And also gold is here on the right side as well. So the SPY index, $428 billion, okay? Actually, 4.2 trillion, I should say, 4.2 trillion. Active ETF examples. These are particular active ETFs. A lot of them are fairly new to the marketplace. One that's really done well is the second one listed here, JP Morgan Equity Premium Premium Income, ticker symbol JEPI, currently brought out only a few years ago by JP Morgan, has 28 billion in assets, a total success. What they do is they write calls on the stocks that they own in the portfolio. So that's done very well. ARK, as you know, has been on a roller coaster ride, and there are others listed here that are very active and doing very nicely as far as interest by the public. The top sponsors of these ETFs, of the actives, are listed here. Dimensional Fund Advisors has got in late to the game, but they're a huge organization with a lot of clout, and they've converted a lot of their mutual funds to active ETFs, and they've taken a huge market share. Actually, they own 22.3.7% of the market. And to see the other companies, we're familiar with JP Morgan, First Trust, and the others involved. So that's the picture there. By the way, I want to mention to you, the number of sponsors used to be a handful when ETFs first came out, maybe 5 or 10 sponsors of ETFs. Now there are over 200 sponsors of companies of ETFs, and a lot of them only have a few ETFs, and they won't last long. But the problem with new ETFs is that they cannot gather assets fast enough, and their daily trading volume could be 5 or 10,000 shares. So these are not going to make it down the road. Okay, the largest active ETFs are listed on the slide. JP Morgan's right on top with their 2 related income ETFs. PIMCO has one as well. ARK is in the picture there. So you can see mostly it's bond, fixed income, and maybe worldwide ETFs. The best 6 months performance as of July 28th in general of ETFs is the Round Hill Bull Metaverse ETF. So that's doing very well at a one-time orientation to the market, which means it's not leveraged. And you can see the performance over 6 months ending July 28th. These are the best performers in the market. And you can see here you have a couple of ARK funds, among others, and Global X funds. This is the QQQ, the NASDAQ 100 performance year to date. And I just wanted to show you that the stocks in this particular index are, the NVIDIAs and the Teslas and all these others, they're doing pretty well, to say the least. And this is the performance through July 30th, the best performers in the QQQ. And NVIDIA is up 219%. So if you're in the right place at the right time, you do very well. Leveraged ETFs have been out for a number of years, and there are bull and bear ETFs. You can go long each one. There are no margin requirements when you buy an ETF that's bearish, because it's a long, you're buying it long, so there's no borrowing necessary. You can have a multiplier to the market of 1.5 times the index that it focuses on, or 2 or 3 times. Like, for example, the TQQQ is 3 times the NASDAQ QQQ. If it goes up 10%, the QQQ, the leveraged ETF goes up 30%, and vice versa. One key feature of the leveraged ETFs is the daily price reset. The price is reset at the end of the day, and that causes a problem. If you try to hold a leveraged ETF in a flat market, the price will decay over time. And also the fact of compounding greatly impacts the return. So if you own a leveraged ETF that's long the market, and the market is falling, you're going to get killed. As happened to TQQQ and others, they can go up 70, 90, 120, 300% over a course of time, and then they can drop 80%. And if you look at the TQQQ as an example, since its inception in 2010, up to the point of, I believe it was February 2022, that ETF went up 18,000%, even with drops of 50 to 80% along the way. So this is definitely not a buy and hold world that we live in for leveraged ETFs. They're strictly trading vehicles and also market timing vehicles. So there are definitely magnified returns. The 2 biggest sponsors of leveraged ETFs are ProShares and Direction. And You can see when you go to their websites, the offerings that they have, it's pretty extensive. The top leveraged ETFs by assets under management are on the screen in front of you. Everyone but one of them is a triple. These are very popular, highly leveraged ETFs. And by the way, if I were to ask you what you thought the highest volume stocks or ETFs were on the New York Stock Exchange each day, I bet most of you would say that the top ETF or the top stock would be like an S&P Spider or the S&P Index. The top two by volume are the TQQQ and the short, the SQQQ. They trade over 100 million shares a day each, every day. So they're very, very popular, especially from an institutional perspective where they try to do hedging in their portfolios. The best 6 months performance of leveraged ETFs ending July 28th. You have the FANG, the triple FANG micro sectors, up 200% in 6 months. And the semis, of course, home builders, TQQ is right up there, the SOX index, etc. A lot of action here. The most heavily traded ETFs, right over here. These are in order, by the way. So you can see the QQQ is even about number 6 here. Spiders are 3, and the 2 leveraged ETFs are monstrous in their transactional volume. As far as how the ETF world has done over the course of the year, this slide captures some of the key categories. One that I'd like to focus on for a minute is the sector area. The sectors are these are 12 spider sectors. The top ETFs are consumer discretionary and the technology and communications. And look at that compared to healthcare. Healthcare is down for the year, believe it or not. So there's a lot out there. You have countries, you have emerging markets, you have commodities, you have fixed income, you have the standard indexes, but there's a tremendous variance between the performance of each of these ETFs. Therefore, it's up to you when you're investing or trading to know what you're doing, be very careful, have rules that you follow, and try to be aware of the risk factors involved. I have a little diagram here of what happens during the investment cycle. And what happens is that during the beginning phases here, there's optimism in the market, and then it becomes euphoria, like what happened in 1999. I'm not sure if most of you are aware of what happened there, but the NASDAQ index went up 86% in 1999. And of course, then we had the beginning of the crash in 2000. In the month of April 2000, the NASDAQ went down 25% in 1 month. So where we are, we may be up here right now, but we don't know. We could be over here. No one knows where the market is, and no one can forecast it successfully. And that's why you shouldn't pay attention to anyone on Wall Street who tells you what their opinion is, because it's useless. Most people don't buy stocks when the market is low. When stocks are cheap, people don't buy them. It's only when they're expensive they get excited. And this cycle goes on forever. It will be there forever because it's based on human judgment and emotion. As Walter Wriston said, the former chairman of Citicorp, all of life is the management of risk, not its elimination. So be aware of that. What mistakes do investors make with ETFs? They may buy the wrong fund because they're confusing the name or the ticker with another ETF. I've seen that happen. Investor selects a concentrated portfolio in an ETF, and they don't realize that it's going to move much quicker and have much more volatility. And also, it may not mirror the market returns. So investors really have to understand what they're looking at when they purchase an ETF. As far as an investing strategy, you have to know your own risk tolerance, what your time frame is. If you're trading the markets for a certain amount of your money, that's not what you'll be doing for your retirement account. So you may need different ETFs in each of those categories. One example would be if you have a retirement account, you may want to diversify it. You may want to use a couple of ETFs. I've given you 3 ticker symbols, VTI, VXUS, and the bond. Those are all Vanguard. And you can put a third in each and let it ride. It's up to you. And of course, use market timing if it's in a retirement account to determine when you may want to change the rebalancing. Since you have no tax consequences in a retirement account, there's no problem in making changes there. There's been some newly launched ETFs in the past couple of weeks. I've listed a couple here. You could see that that 4 of them are fixed income related. Again, with options and global focus. So these keep coming out day after day after day. As far as more information on ETFs, I've listed for you 5 very good websites, which you should check out. They're all free. Also, sponsoring firms. If you want to know the exact information about an ETF, check out the prospectus, check out the fact sheets on all the sponsoring firms. Go to State Street, go to Vanguard, go to Fidelity, go to Dimensional. They have tremendous websites, a lot of it with educational content and all the critical information you need about ETFs. And the brokerage firms also have extensive information. So use those resources. I've also listed a couple of books for you that you may want to check out, realizing though that the book, may be a little dated because things change over time. And there's a lot of books to read about the markets. These are a couple that you may want to think about. As far as the analysts are concerned, these are the latest estimates of where the analysts think the market's going to end at the end of the year. In January, they had less aggressive targets. Now they have bigger targets. You can see here, there's only like 2 or 3 out of this group that think the market will decline between now and July. Most of the time you get these targets from the analysts. Every year they're bullish and they never go bearish. And that's the problem. It's a waste of time to listen to them. And remember what Jesse Livermore once said, the very active speculator in the 1920s. There's a time to go long, a time to go short, and a time to go fishing. And John Maynard Keynes, the famous economist, said, "When the facts change, I change my mind. What do you do, sir?" So look at the markets, evaluate them, use rules, and you'll end up doing very well. And certainly consider ETFs as a way to accomplish your goals. Be happy to take any questions at this point.
All right, I'm back here with you, Les. Just for the time being as well, to help with whatever questions are out there. I don't know if you can see the chat or not, but because after we go through the Q&A, I will wrap us up for the day as well.
Okay. Any questions coming in, Glenn?
I'm looking. I think a lot of people really appreciated what you had to give. Hold on. Excellent presentation. Fast, to the point, interesting, and educational. One of the best ever. Elizabeth says, this is excellent information. Kudos to the person who planned this presentation and to the presenter. And a lot of people are looking for the slides because they really liked what they saw. So I think that man, this hit the spot. This is what people were looking for. This is exactly what people were looking for to add to their what's the word I'm looking for, Joey? To their toolbox. Absolutely. How does VectorVest help analyze ETFs? I'm going to field that one if you don't mind, Les.
That would be my pleasure, Glenn.
All right. So the biggest thing is, because an ETF is like a mutual fund or like a fund, the biggest thing that we're going to look at in an ETF is going to be the RT. All right, so we want RT to be above 1. Now, a lot of times as the market moves, you're going to find ETFs, whether bullish or bearish, that are not above 1 yet. But if the market starts to move, you're going to watch a rise in ETFs. So that's what you're going to have happen. Joey is our producer, Akshaya. He's with me majority of the time when I do my my live streams. John says, thank you for your presentation. I hedge my portfolio with SPY all the time and trade long and short diagonals with SPY. How many ETFs do you recommend in an account at a given time? I'll let you answer that. That comes from LaQ.
Well, as far as it depends on if it's a retirement or it's a trading account. If it's a trading account, you can trade a couple at a time. In a retirement account, you can have 3 to 5. I mean, that covers the universe, depending upon how many slices of the world you want. In other words, you may be a very conservative investor, but you may want to put 5% in gold, so you can buy GLD. That's the beauty of ETFs. You can put 80% of your portfolio into core products, core indexes, and the other 20% break it up into 4 ETFs, different slices of the market. It's really up to you. But try not to make sure you have an overlap. Check the overlap of the portfolio among ETFs, because if you buy say a couple of large cap ETFs, they could be 85% overlap.
So I just looked at my own personal portfolio. I'm only holding 3 country, 1 long and 2 other country ETFs. Out of all of my holdings, I've got only 3 ETFs in my portfolio right now.
Right. There's no need to have a lot of ETFs.
I agree. How many ETFs does VectorVest track? Joey,
I believe it's 1,800, I believe.
There you go. That answers that question. I was going to go peep that out. What are you looking at these days in terms of 3 times ETFs?
Not sure what the question means.
I'm not sure either, but remember I answered the question of how you can use VectorVest to analyze your ETF. So I'm looking at the same thing, whether it's a non-leveraged, double leverage, or triple leverage ETF. I'm still going to use that indicator of RT to help me to manage.
Right, and also you have in your watch list, you do have double, triple ETFs for people to look at, to pull up portfolios of that and see which are the strongest in those categories.
Absolutely, especially depending on how you invest. If you're looking at a triple leverage contract or triple leverage, you made a great point. They're trading vehicles, and I think that a lot of people get caught up in, holy smokes, this ETF is making me a lot of money. They want to hold it on, and then they take a big hit and they wonder what happened.
What happened is they'll end up in the poorhouse.
Yes, absolutely right.
Rick, you have a copy of one of the 2 people in the country that have a copy of my book. That's amazing.
There you go. The day trading edge. The day trading edge. How do I get a copy of that, Les?
Right to Amazon, or it can go to eBay. I'm sure people have it in their garages.
All right. I'm thinking I might have to go look at that. I'm going to take another question. I've added Feng U and Feng D ETFs to my trading. I think that that's a good one. You know what else I think is a good one, especially if you really want to be super aggressive? Look at Boyle and Cold, both playing natural gas. I've never seen ETFs that volatile ever than those 2, Boyle and Cold. That's only for you people that have the strong innards to handle those 2.
Glenn, I want to add one more to that. NAIL, N-A-I-L.
There you go, the builder one. Yes, yes. That's for all you hardcore traders out there to take a look at. All right, Joey, is this the screen that's got all of us up on right now? Do you have a screen that's got us all up right now? Oh, it does. I'm looking at it on YouTube. All right. So, one, Wes, thank you so much for your presentation. For everyone who really got something out of that presentation, put a 1, type a 1 in the room. Type a 1 in the room. Hit the like button. That's exactly what the International User Group is all about. What you did right there. What you did right there. That was an amazing presentation, and I see the ones coming in. That was right on point for what this platform was built around and based upon, is what you just did. So
thank you very much, Glenn, and everyone out there. I appreciate it. And you can see I have a passion for the subject matter, and I love to make presentations on an educational basis for everyone to benefit. So my pleasure.
all right. And Rick, from our VectorVest family, bringing you on board, I stand pretty much passing the torch to a certain degree. Welcome aboard. For all of you all who appreciated what Rick did today in the deep down dive on all of the markets, type a 2 in the room. Again, my friend, welcome aboard. I look forward to working with you when I have an opportunity to do so. But I think
Thanks
that
so
was
much,
very detailed, and it pointed VV Nation exactly where they needed to be in every. There was no doubt. There was no doubt in anybody's mind where they need to be by way of your analysis. So, thank you for that.
Thanks, Glenn.
Glenn, before you leave, I want to mention about if the people go to the VectorVest.com website and click on the blog, they can see so I have about 10 articles on ETFs on the VectorVest Hot Stocks blog.
Excellent.
They can get that. Yeah, they can check that out. And also, if they put the word ETF in the search box, they'll come up with all the ETF articles that I've written over the past 3 months.
All right. And last but not least of all, Stan Heller, being able to feel confident in that we have someone to help out with him as he goes through retirement. Retirement's a great thing. Retirement's a great thing, and Stan's getting that opportunity thanks to Rick to help him out. And of course, everybody type a 3 in the room for everything that Stan has done for this international user group. He was the person that put it all together and has grown it to where it is. Type a 3 in the room for Stan for everything that he has done for this international user group. All right. Folks, don't forget to hit the like button. If you're brand new to the channel, and we do this once a month. We do this once a month. If this is something that you want to come back to, hit that subscribe button, hit that bell icon so that you'll be alerted to when this comes out. This is an awesome group of people. And we all know that, unfortunately, we are missing one of those people. It is unfortunately and sad, but as we get and go down this path, we will keep you in the loop as to what's going on with all of that as well. So I don't want to sell that short. All right. And that's all I'm going to say about that. Folks, thank you very much for being here. Thank you for making this one of the most widely watched live casts or live stream on our channel. All right. So with that being said, I'm going to sign off for all 3 of us. Adios, arrivederci, ciao, au revoir, sayonara, aloha to all my peeps in Hawaii. Bon dia, salam, shalom, namaste, yasu. Until next time, folks, see ya.
Thanks, folks.